Hello and welcome to a special episode of Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. As women, we juggle a lot: careers, families, other responsibilities. And in the midst of all this, somehow our own financial security takes a backseat. A lot of women have to take career breaks. There are numerous studies that show women tend to live longer than men, which means that our retirement savings, they need to last longer. So today with Dhirendra Kumar, let's discuss how to make that happen. And I can see, Dhirendra, you're wearing, you've ditched your signature white and blue shirts for a pink one. So
No, this is all my audiovisual team, and they've made me do all these things. In fact, they have bought this pink shirt for me. So I've kept it very simple. My wardrobe is full of things where I don't have to make a choice.
So happy Women's Day.
Thank you.
Happy Women's Day. Now let's begin today's conversation with, a lot of women, they have to take career breaks, be it health or other reasons, but this can disrupt their retirement savings and the plan that they have probably in their mind. So how can we bridge these gaps and make sure that the retirement savings, they need to last longer for them? As we were discussing, most of them outlive their male counterparts. So are there any specialized strategies or products that can help them do this? And there's a second part to this question, but let's handle this first.
No, before I actually answer this question, of course, everybody needs to be financially independent. Women need to be financially independent and be focused on that. There is no independence without financial independence. Right. If you really don't take note of it, if you don't take this seriously, bad luck. It'll just be a notional thing that you are financially independent or you can think independently. But without financial independence, everything falls flat. So taking it seriously. And then what are the necessary steps towards that? One is to, it is nice to actually have a family finances being looked together, and, the family or the couple will retire around the same time or a couple of years here and there. You have, joint responsibility. But financially independent, or the financial independence for men as well as women, requires the same thing. You need to really earn, save, invest, and be very methodical about it, being very rigorous about it, being so disciplined about it that it is a non-negotiable thing. Add to it, that women will live longer. The other is that, there are certain advantages why women need to really take charge to a great extent. Simply because, men might be ambitious with their investments, or, they might be more knowledgeable, or, the environment is something where, they might have more information. There is something, which I actually learned from my interaction, or, I was talking to Faye D'Souza, and she was telling me that, there is one thing which is a very distinct advantage women have, is that they don't have to brag about their wins. They don't really have to be a winner. They have to be methodical. They have to be well off. They have to be systematic. And I think that is where, the first barrier which everybody should get, cross is that you have to feel the necessity that you have to be informed. You should be aware that, okay, you have to take these steps. And what are those steps? Investing for the long run. Investing in equity for the long run, being methodical about it. And in the absence of the urge or desire to actually claim victory, you can
it's just not there.
Yeah. So, you can actually, you are far better acclimatized to tide over, invest for the long run, simply because, and this will require absorbing things, understanding things, and when you should not panic, why you should be methodical, and why you should not, the moment you have accumulated some 80,000 rupees, the first 80,000 rupees with your 5,000 rupee SIP, how not to get tempted to buy that LED TV. So men and women, they have the same challenge, except that they are better geared and they better take charge of it. If women in the family actually take a little bit of responsibility and are able to absorb this carefully, and they should really take charge of the finances, simply because they are temperamentally very meticulous about it. That's one. If at all they have to, they should delegate a part of the fund allocation to the men. Say if your family savings is going to be one lakh of rupees or 50,000 rupees, and men have this temptation to actually act in a manner where you have to win, you have to do something, or you have to bet on something. Maybe or build a great portfolio. Start with giving away 10% of the savings to men to try out their strategy. 90% be methodical about this. And in 5 years' time, it will be demonstrated. If the man proves that he has done better, maybe delegate it to him. But if you have done better, maybe confiscate the remaining 10% and make it 100%.
Great. So in this journey of saving for the long run, can annuities and pension plans play a role there?
Pension plan do play a role because everybody's life broadly divided into the stages of life. You have an accumulation phase and you have deaccumulation phase. When you have accumulated and then you start consuming it when you stop working. And a good part of your life you'll be working. If you're working, if you're earning, then you're saving and then putting it to work. Annuities come in the deaccumulation phase. Your investment plan or your life is your pension plan. There could be a lot of intermittent short-term requirements, necessity, child's education or the down payment for your house and the EMI subsequently. Those are intermittent things, but all other goals are very tangible and time-oriented things. Some of them are negotiable, some of them are non-negotiable. But retirement is not negotiable. You will retire. Maybe, even if you're self-employed, you will retire at a certain stage, and then you have to prepare for it for the period you will live. And not outliving your savings is the goal.
Yeah.
And if that is the case, annuity is one of the options when you retire. And investing in a pension plan is another option. It is not the only option, or it's, you don't have to necessarily invest in a pension plan for your retirement. You could well be in building a stock portfolio. You could well be building a portfolio of mutual fund and stocks, or just mutual fund, or just the NPS, the pension plan itself. But that is one of the options. The real thing is that you should be disciplined enough to earmark something for your retirement, making sure that you don't touch it, ensuring that it is not something which you are going to lay your hands on unless there is an extreme emergency, there is an emergency. And so think of it in terms of accumulation and deaccumulation phase. And when you have time for your accumulation, make sure that you are very focused on that. And this is not a money which you will touch. It requires discipline, foresight, and understanding and appreciation. Visualizing the negative scenario, feeling one is to be optimistic that the world will be better, and it's a general bet on economy and the investment outlook will be good enough. And in 10, 15, 20, 30 years, it generally happens to be much better than the previous 20, 30 years. But at the same time, worrying about one particular aspect, that if you consume it, what will happen when you will not be able to work and you will not have the financial resources?
Right. Now the big question, how much is enough? Because women, as we were discussing, they tend to live longer. So the retirement corpus, it has to be sufficient to, last that much longer. There are healthcare expenses to be taken care of and much more. So how should we determine the right retirement corpus?
Nearly impossible to predict it, because everything changes in 10, 15, 20 years time, which means that if you're planning to retire 20 years from now, 15 years from now, a lot of things will change. The cost of healthcare insurance will change. The cost of long-term care insurance or long-term care will change. So it's very difficult, but still I would give some broad rules. It is better to actually prepare for something with a target, with something in mind. I would say that, having 20 years worth of your monthly consumption is the essential capital needed. Why 20 years? Why not 12 years? Why not 15 years? It could well be 12 years. It could well be 10 years. But this is just erring on the side of caution for inflation, extraordinary inflation, some extraordinary situation that can arise with your health. All these things can go haywire. 20 years is a good enough thing. And I'm not talking of your earnings. 20 years worth of your expenses. And if you are able to prepare with this, have this much of capital, then I think, and invested diligently and in a manner that, a part of it is in equity, part of it is in fixed income, and you have gotten used to equity and you don't really freak out when something like what happens, in the market every now and then happens, then I think, you will have the cushion, you'll have the shock absorber, you'll have the safety.
Okay, so 20 years of my expenses today, do I need to factor in inflation there?
No, this 20 years I'm actually factoring in there, but the more the better, because everybody's situation is going to be unique. So your accumulation, which is equal to 20 years worth of monthly expenses, even at current rates, should be the minimum which one should be targeting.
All right, now let's talk about investments. Many of us are comfortable investing in gold and FDs because they just feel safe, while equity feels risky. So is it enough to invest in these instruments? And second part is how to acclimatize ourselves or how to build confidence in market-linked investments.
No, it's not a matter of choice. You have, by all means, invest in gold. Invest in gold, but just understand what are you investing? Why are you investing? Is it an investment or is it a consumption? If you have some jewelry, it has a context. It's an emergency fund as well. You can actually fall back on it in case of dire situation. But understanding that how things work, you have to invest in a productive asset. You have to invest in an asset. You have to make an investment which has the potential to beat inflation. By investing in equity, you are becoming part of the real economy. You invest in the company's stock. You become the owner. As the owner of a company, or the company itself, you as the owner of the company, by investing in those stocks directly or through a mutual fund, you have an asset of a company which is offering a product or a service, and the price of which has to be adjusted for inflation. If it is not going to get adjusted for an inflation, it will get out of business, it will get phased out. It will be an uneconomic activity. So in that sense, being a part of real economy, which in itself gets adjusted for inflation, that is the key. In between, there are a lot of risks. Many companies become obsolete. Many companies go wrong with some of their judgments, some of their economic cycle they are unable to withstand. And that is why you should diversify. So you have to do these 3-4 things. One is to diversify, invest in real companies, and investing in stocks through mutual fund or directly, and be able to tide over, because it is going to be like this only. By all means, have your jewelry. Don't look at it as an asset. Think of it as a consumption and a fallback in case of emergency. If at all, by all means, invest in gold to an extent that a gold fund could be an option. There could be a multi-asset fund which can have 5-10% into gold. That could work as a good balancing factor. It could be a shock absorber. Many a times equities and bonds both tank, and they're all market dependent. Sometimes interest rates could be going up and the stock market also going down, and then you'll feel that even a balanced fund which is investing in equity and debt, both is crumbling. And that is when this gold actually provides some kind of cushion. But that is not a long-term cushion. Gold cannot be a great long-term investment. It could be one of those balancing factors. By all means, have something, some exposure. Investing in equity is paramount. If you don't invest, if you don't get used to equity, you are doomed. Because if you are going to live for 70, 80, 90 years, and you are going to work till your age 60 or 65 or even 70, those 20, 30 years are to be taken care of from the investments that you have made while you are working, out of your savings in your working years. And to have an asset which can actually beat inflation consistently over the long run, equity is the only promise. And equity is a very risky promise the moment somebody tries his hand. Because most of the time, people don't look at equity as an investment to be made for the long run. And it also delivers superior return. What has happened with Sensex, 18% annualized return over the last 38 years. But the problem is that, this high return, beating inflation by twice as much over such a long period of time, the magic which people experience, it comes with a very erratic, journey. It has to be learned by doing it. So how to do it? Get started with, little conservative vehicle, something like aggressive hybrid fund, not an all equity vehicle. And I think, women are better geared for all that, simply because, the moment you develop an appreciation, develop the understanding of the principles, they can adhere to it. They can actually be a little more rigorous about executing the plan without the temptation of being a short-term big winner.
All right, then investing is not just about numbers, it's about securing our future, our independence, our peace of mind. So, like we discussed, start early, invest wisely, and let compounding do its magic. That will take care of a lot of things. Now, moving on to the viewer's question. This viewer has written that he has a peculiar problem. During rebalancing over the years, he has stopped SIP in a fund and started the same category SIP in another fund. But in the process, not to attract tax, he has kept the old funds and only sold out the funds when the returns have been below the benchmark, or Value Research's website rated it 2-star and below. But he has 6 current good 4-5 star rated SIPs, total 12 to 13 funds, mostly 3-star and above. This is a situation that he has. He wants to know if what he's doing is correct, or should he sell and trim down to only 5-6 funds and don't worry about the tax.
Yeah, I would like to, inform him that he is doing a great job. Having 12-13 funds is nothing wrong. There is nothing wrong with it. When we say that 5-6 funds are good enough, which means that if you are starting to invest and having 5-6 funds is good enough to gain exposure to all segments of the market. You can achieve this in multiple ways. You can have it with 2 flexi cap fund or 2 multi cap fund, 1 small cap, 1 mid cap. What happens is that many investors actually have taken it to heart that having more than 5-6 funds is bad.
Yeah.
In fact, the only thing you should be worried about is not have too many bad funds. And making sure that you have meaningful exposure. There are 2-3 rules which I will follow. One is that having 10 funds is not bad if the funds are good. But having 10 funds and of which 5 funds you have 0.5% of your total money is a bad idea, because it's neither here nor there. If those funds do exceptionally well, you are not going to benefit. And not only that, you are not interested in those funds. If you have 10 funds, make sure that any investment is not less than 5-7% of your total exposure. So that itself will keep the number to about 20. Don't sell, because I agree with him that long-term capital gains will actually reduce his money and that will stop functioning. So sell a fund only if it turns bad. Sell a fund only if you need the money. And there is no third reason. And make sure that you have a meaningful exposure to any fund. And that meaningful exposure should be 5% or 5% of your total money in some foreseeable future. You start your 10,000 rupee SIP and you plan to continue it for next 3 years, and then it will be 7-8% of your total investment. That's fine. You don't have to really scale down all your investment to reduce it to 5-6. No, that is not what I mean when I say that 5-6 funds are good enough.
Okay. All right. So, ladies, let's take charge of our financial journey and build the retirement that we deserve. Thank you for watching today's episode. Keep watching for more information. See you next time.